Welcome to today's Merk webinar. We will be going over our outlook for 2018 and how to position your portfolio for the new year. On today's call, we have Merk's President and Chief Investment Officer, Axel Merk, and myself, Financial Analyst, David Song. At the end of today's presentation, we will have a Q&A, and as always, we do encourage questions from the audience, so please feel free to ask a question at any point during our presentation by typing it into the questions box on your screen. This presentation will be recorded, and with that, I will now turn the call over to Axel to begin the presentation. Axel, the floor is now yours.
Thank you, and welcome everybody. Thanks for being with us, and I hope I can give you some food for thought about what to think about as you are contemplating about the investments for next year, or more importantly, about how to stress test your portfolio as to what just might happen. And this cartoon that you're seeing here, it's not our own. We used as an example as to have you really looked at your portfolio? And the background here is, and those who have followed us for a while are fully aware of my concern here, is that environment where stocks go up and up and up. If you have a certain risk profile, odds are that your portfolio is now riskier than it had previously been, simply because so-called risk assets have outperformed other assets. And so if you have a 60-40 portfolio, meaning 60% in stocks, 40% in bonds, well, that 60 portion is probably now 70 or 80. And by the way, your bond portfolio is probably not a bond portfolio anyway, because you've been chasing yield. And if you chase yield, well, the higher the risk in the bond portfolio is, the more closely it is likely correlated with your risk portion of your portfolio. Meaning, if you take 2008 as an extreme example, junk bonds fell as much as stocks did. And so the question is, are people really diversified, and have you done your things, your homework? And I'll talk about a little bit about the sort of ways to look at the market and what risks to look out for, and then notably, of course, what we think is happening in the world of politics, what it means for the portfolio, and in currencies and the like as well. Just to be on that chart, earlier today I tweeted a question with two choices in a poll, and I asked pretty much, what do you think is more likely, that the average volatility in next year in the S&P 500 will be above 15%, or that the price of Bitcoin will be above 50,000? And the answers were fairly mixed, a tad in favor of Bitcoin over 50,000. Now, if you think about that, clearly the volatility in the stock market has been very depressed, very, very low, in the 9% range or so. But historically, since the early 90s, the average volatility in the stock market has been just under 20%. And so you would think that an average volatility of 15% is not such a crazy idea. But apparently, a little more than half of the respondents thought that it's more likely for Bitcoin to be above 50,000 than to have quote-unquote normal times return. And I'm not suggesting that we necessarily will see an average volatility that high, but I would at the very least think that what historically has been the norm may well return. Or with anything I say, it's not so much whether I have a crystal ball and know exactly what's going to happen. I don't have a crystal ball either, but I see my role as asking you about, are you considering certain risks, and have you taken precautions in your portfolio if that really happens, or are you comfortable with that happening? And so in that spirit, let me first look at a very traditional way of looking at the markets. And what this chart shows here is the S&P 500. That's the upper black line here, and it's a log scale. And then in the blue shaded area are when we've had recessions. There's a very long-term chart since the early 60s. And then in the bottom part of that panel is what's called an underwater chart. That is, how far have we been from the top in the market at any point in time? And what you see here is that during recessions, bear markets have tended to be more prominent, and more importantly, bear markets have been much less likely or not at all if you haven't had a recession. And there's a very notable exception here. If you go to the middle of the chart on the bottom is the 1980s. We had the 1987 crash where the market did go down quite substantially. And note, by the way, this is based on monthly data. And so if anybody wants to look at the details, the intra-month numbers might look a little different. But still, there is a prevailing theory out there that if we do not have a recession, we cannot have a bear market. Now, I'd like to caution that I'm a tad skeptical in the current environment about that, but history is what it is, and historically, it has been very, very rare that bear markets have occurred. And indeed, the buy the dip crowd will point out that the 1987 crash was a good buying opportunity. And so the way I look at this, by the way, is that the reason why people do not buy the dips when there's a crash is precisely because they haven't rebalanced their portfolio. If you've taken chips off the table during the good times, you have the ammunition to buy the dips or to cost average. Whereas if you haven't done that, you're now overexposed to risk assets. That means in the downturn or in a crash or bear market, whatever it might be, you lose more than you're comfortable with. And so then you got the sleepless nights, and then you take chips off the table at the worst possible moment, and then the markets recover. Yes, indeed. But those that tell you to double down, well, that's completely irresponsible because you have lost more than you were comfortable with to begin with. So you got to rebalance your overall risk profile. So in the next couple of charts, I'll look briefly here as to where we are with regard to the economy. And most notably, this particular chart here shows the GDP numbers that we've had them quarter over quarter. And then the black line is a model by the Atlanta Fed that tries to forecast where GDP is going to be at the next reading. And so that suggests that, yeah, everything is dandy, right? We are around 3% GDP growth. Another way to look at how the economy is doing is saying, well, hey, recessions happen when the consumers are doing poorly. And there's been a lot of talk about how the low interest rates encourage the taking of debt. Well, that is true for the corporate sector, but it is not correct for the household sector if you take it as a percentage of GDP, which I would think is a reasonable way of doing it. And so if you look at this chart here, it suggests that there has been an ongoing deleveraging happening in the consumer since the 2008 crisis. Corporations in return, though, have geared up. And so corporations may well be more interest rate sensitive than they have been, whereas consumers are less. Now, that said, there are some things, and you don't see them on this chart here. You have things like an enormous rise of student loans. And that does change consumer behavior because somebody who is graduated from college, has a lot of debt, is going to be more reluctant to start a home. They might not qualify for credit. And so it does create other distortions. And so when it comes to any of these metrics, these are just one of the metrics to look at. That said, looking at the overall state of the economy is one way to kind of to gauge the odds of a recession can happen. And if I can make an announcement, on Thursday, that's in 2 days for those of you listening live, we are going to send out a special research report where we dive very much into the business cycle and go into this sort of thing in much more depth. And would love to get your feedback on that, whether you'd like to hear those sort of in-depth coverages, much more economic talk than you probably have heard since you've taken Economics 101, but to give you a real appreciation for what's behind it and thinking about this sort of theory. In any case, let's think a little bit here of what's happening and in the economy, and one of the reasons that's also relevant is here is a chart that shows Americans on disability. Now, the reason I show that, because in a moment I'll show you a number related to the labor participation rate, because those numbers are relevant to gauge on how much more tightening the Federal Reserve is going to do. Well, in any case, this chart here shows how many Americans are on disability. They peaked out a little while ago, but they have been coming down. That means that A tight labor market encourages people to get off disability and joining the workforce. So when you get the monthly unemployment number, the unemployment rate is only of the people who are looking for jobs. And if you're on disability, you're outside of that workforce. And so it's one of the reasons why the unemployment rate hasn't come down further, is because that as the economy grows, more people are coming from the sidelines to join the economy. And one of the key areas that the Federal Reserve might be watching, and that we in general might be watching, is what's happening to the so-called prime age workers. We all know that there's a demographic trend of the baby boomers retiring that's been a major force of the overall labor participation rate going down, meaning that we have fewer people working as a percentage of the population as there used to be. But there had also been a troubling trend that folks who are between 25 and 54 weren't working. And you saw this big drop after 2008, and we still haven't fully recovered from that. People leaving the workforce, and the longer they're out of the workforce, the less qualified they are to go back into the workforce. And so there's a theory that we haven't reached full employment until those prime age workers are back at work. And if you look at this gray line that tries to draw an approximate trend line where that has been, that the number has been down. And by the way, people go on disability because of the disability benefits. And so the more welfare there is, the more likely people are to absorb it. That's not an argument for or against welfare. It's just how incentive structures work. And so as we have more social incentives in the system, fewer people will be inclined to work. And that's why over the years, there are fewer people in the labor force. But the question here is, if this trend line is correct, we still have this so-called slack in the economy. And so the Fed can, quote unquote, try to run this economy a little bit hot, because they think, at least the Yellen Fed would think, that we can keep interest rates low a little bit longer before we run out of people to hire, because once you get there, you're going to get inflation into the system. This might be one of the reasons why, even though the economy is growing at a decent clip, you don't have inflation to go too much. So let's switch from the economy to a little bit more of what the Fed is doing. And I've shown you this chart before, and it's really a placeholder more to talk about the quantitative tightening that has started now. Basically, the Fed balance sheet has been inflated, and the Fed has announced they're going to reduce it. The Fed has told us that reducing the Fed balance sheet is watching paint dry on the wall. I have said that that's complete BS. I stand by that. Now, that said, this chart here shows that there's a cap on how much they want to allow to run off of the balance sheet. And at the same time, you don't have the same amount of securities mature each month. And so as you have things mature, those proceeds can be reinvested. And they're not going to be reinvested, as it shows on this chart, to fill kind of the buckets coming up. But the minimum, I think, duration they're buying is, I believe, 2 years or so. And so it's a bit spotty of how much they'll reduce the balance sheet. However, they will reduce the balance sheet. And my framework of thinking about QE has been that what QE, quantitative easing, has achieved is to compress risk premia. And what that means is to take fear out of the market, to reduce volatility, to make junk bonds not yield anything much more beyond treasuries, to reduce volatility in the S&P. And so that return increases asset prices. Well, the flip side of that is when you have quantitative tightening, you have headwinds, all else equal. Volatility should rise, asset prices should come down, the spread of junk bonds over treasuries should increase. That should all happen. Now, the Federal Reserve has told us, no, financial conditions are not, don't want to get them to deteriorate. I'd like to caution that the whole point of raising interest rates is to tighten financial conditions. That's why you raise interest rates. And the same thing with quantitative tightening. Now, that said, let's look at financial conditions. Here we see in gray the S&P 500, and in black the financial conditions index. That's an index of a whole range of different indicators that metrics of financial conditions. And yes, the Federal Reserve has raised rates, but financial conditions have indeed continued to improve. And so if you want to take a step back and think about what happens in an economy when there's a central bank active, an economy does well, the central bank starts raising rates. Well, just because the central bank doesn't raises rates, it doesn't mean the banks won't continue lending. Indeed, the reason they're raising rates is because things are doing so great. And so banks provide easier credit. They can ease lending terms even as interest rates go up. And then usually central banks continue to hike rates and saying, no, 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 we actually want to slow down the economy. And that's why almost always you don't have what's called a soft landing. You don't have the banks to tame the spending just enough so you don't get a recession. Almost always, historically speaking, you do not have a soft landing where then things go slowly back down, but instead what you get is you get a recession. And here, obviously, an extreme example in 2008, where financial conditions did, quote unquote, deteriorate, and then the central bank reacts by easing again. Now, we show it here with the S&P 500. A central bank will always tell you that they will not set interest rates based on the S&P. They will, though, set it based on financial conditions. And my claim is that these days, those might be the same thing. Because central banks have pushed asset prices so high, a direct result of QE, as they tighten financial conditions, the S&P may also go down. And so we are not there yet. And obviously the S&P has continued to climb, but that is something that we do have to pay attention to and worry about. And so to kind of get a tad more technical in this discussion, and I'm sorry for showing you 3 curves, but I want to get a concept across here. There's been a lot of talk about a flattening of the yield curve. And so before I lose everybody, let me just try to explain what that is and what that means. Historically, short-term interest rates are set by the Federal Reserve. And so that's the black line in the upper panel. And so you see that that's the middle line there. It's moving higher as interest rates have been moving higher. And then there's the longer-term rates. Those are supposed to be dictated by the market. I say supposed to because QE and the like has interfered with that a little bit. But in any case, longer-term rates are more of a metric of what the market believes the long-term returns are going to be, and it's a longer-term yardstick. And so what happens when a central bank raises rates, several different things can happen, but what's happening here is that short-term rates are going up faster than long-term rates. And so that's when you talk about a flattening of the yield curve. And the lower line that you see here is just the difference between the 10-year and the 2-year. And so the idea here is that if the flatness goes so flat that it quote unquote inverts, that short-term rates are higher than long-term rates, that what it leads to is that is like the Federal Reserve pushing the brakes. And a lot of people have wondered, well, why is this? Don't we have this wonderful tax reform and things like that coming up? And my view is that, well, all this tightening will have financial conditions deteriorate and will provide a headwind. So let's talk about here a little bit, because I just mentioned that the 10-year rate is a little bit of what the long-term growth expectations are. Well, here again, you have the black line is the 10-year yield. And this is a comparatively short-term chart. It's since the inauguration of President Trump. And it reflects the sort of Trump trait. And to kind of exacerbate that, and the gray line is the Trump approval rating. When Trump came into office, he said, I'm going to have amazing tax reform. I'm going to have an amazing infrastructure spending, and long-term growth is going to increase. Well, if long-term real growth is going to go up, that means the 10-year rate tends to move higher, meaning the 10-year bonds are going to fall down. And what has happened is that as the summer approached, the 10-year rate came down as the odds of a tax reform fizzled out, odds of infrastructure spending fizzled out. But in recent weeks, the odds of a tax reform passing has increased again. And with that, the 10-year rates have increased again. And one of the things I have argued in the past when it comes to something like gold, the biggest competitor is really longer-term rates. If you get compensated properly for holding a 10-year, if you're holding a 10-year bond, well, why should you hold this brick that doesn't pay any interest? And so the question is, are we really going to make America great again? Meaning, are we really going to get high real growth or not? And so the judge is out on that a little bit right now. It does look like we're going to get tax legislation, and we write here legislation rather than reform. Part of it is because if you want to get true reform, I think you would need to have some very serious principles behind it, and I have yet to identify what those serious principles are. The one thing, obviously, that appears to be a big driver, and that's nothing new, I'm telling you, is corporate taxes coming lower. But there are a lot of little confusing provisions, and so when all is said and done, the question is how much of this great growth that we're supposed to be getting is priced in, and how much are we supposed to be getting going forward. If you listen to the folks at the Fed or many others, they say, yep, as we move forward, rates have to move higher. Short-term rates are going to move higher, and long-term rates are going to move higher. Long-term rates have to move higher because the Federal Reserve is going to reduce its balance sheet. Well, my view is that as the Fed reduces its balance sheet, you're going to have a risk-off environment because financial conditions deteriorate, increase in volatility, and people will actually buy treasuries. So I wouldn't be surprised if we're here a year from now and the 10-year will not be higher than it is right now. And so the judge is out on that, but we'll see. So now let's put this a little bit into context of what's happening internationally. The red line is the Federal Reserve. The Federal Reserve, obviously, ahead of the game, having quote-unquote tapered. And that red line is, if you look very, very closely on the right-hand side, it's starting to dip down a little bit. The Bank of Japan, which is the black line, has slowed down its purchases. They have these multiple targets these days, and the most relevant being that they want to fix their own JGBs, the 10-year rate in Japan, and they don't need to buy quite as much as they had anticipated, and so they don't need to buy as much. But the European Central Bank, Mr. Draghi, is out there and very actively buying, and so the European Central Bank balance sheet continues to buy. A lot of folks out there say this bonanza in the markets is going to remain until the ECB stops being such an active participant in the market, which would be a September of 2018, maybe a little bit earlier when people will price it in. That's possible. I am just very reluctant always when everybody says something will happen at a certain point to think it's going to happen right then and there. And again, back to the kind of the argument of rebalancing a portfolio. Rebalancing when times are good might be a more prudent way than to wait when you know exactly it has to happen because of this or that event happening. Because as much as I might have a view of what's happening in the market, that's just a view, and obviously, as I indicated, it's not a crystal ball. So let's compare the 10-year rates here between the U.S. and Germany. And the reason we should do that is because historically, the difference between these two rates has given us a lot of clue about how these different exchange rates are moving. But here, the most noteworthy thing here is that the 10-year rate in the U.S. is much, much higher at 2.4% as of this chart, which was on the 11th, versus the 10-year rate in Germany at only 0.3%. And so something is likely to give, doesn't have to, but is likely to give, in my view, that either the U.S. rate is going to come down, the German rate is going to move higher, or if it stays, that maybe the euro should come down to reflect that. And there are always plenty of euro bears out there. It's just, historically speaking, been extremely difficult to get that euro to weaken, despite what all the pundits would like it to be. And so let's look at Europe here a little bit more closely and see what is happening and what might be happening. This one here is the percent of global debt that is negative, and that's based on a Bloomberg chart. I didn't go out and count every single debt security out there, but and most relevant is that this is a very consistent measurement over the years, and we've had a peak in negative yielding debt in 2016, and that number had come down, but it's still hovering at quite a high level. And the question is, what is going to get that to come lower? And obviously, a big chunk of that, or the bulk of that, is in the Eurozone. By the way, not just the Eurozone. Sweden, for example, also have negative interest rates. The Swedish krona today did very well because inflation came in a tad higher than expected. being yet another indicator that maybe those negative rates are ridiculous in Europe and they should go away. Now, the reason why they have these negative rates, because they say inflation isn't high enough. If you look at the German economy, for example, it's going gangbusters, but inflation continues to be mute, and so you kind of get away with these low interest rates as long as Draghi is there. Draghi, by the way, is in office until the end of 2019, and so my view is that probably at some point in early 2019 at the latest, people will price in that he's going to be out. And in that context, by the way, German politics will be very relevant. At that stage, Germany needs to have a government, because if they have a proper government, that's kind of the pressure they'll apply on the ECB to put somebody in there who's more hawkish than Draghi. Now, in the meantime, I'm showing you here a chart on Eurozone reform. What this is, and shows the US as well, these are merely several different indices of the ease of doing business in different countries, and the lines moving higher suggest that it's easier to do business. And the only thing I want to show you here is that as much as we love to hate Europe, things have been improving in Europe. Italy, there are some things that are a mess, but it's easier to do business now in Italy than it had been. And if you look at the United States, that the bluish line, that line hasn't improved. And so everything is always relative. There's a reason the euro is doing well. Despite all the challenges they have made reform. Reform is never perfect. Progress is never perfect. But you have relative change. And relative change is that there are some things that are happening that are improving. So I have this placeholder here to expand just a tad on European politics. Let me just chat about Germany here a tad longer. Germany has a gangbuster economy. Right now, they're very happy with the low unemployment rate, but people are complaining that Germany doesn't have a government. Well, the one good thing about not having a government is that a government or a dysfunctional government cannot spend much money. Remember in the US, when we don't have unified Congress, Congress can't spend much money. Everything gets vetoed, or it doesn't go through the House and Senate and whatnot. And so similarly in Germany, then they just don't get much done. Not getting much done, in my book anyway, is quite all right when things are in reasonably good shape. When you have a crisis and your hands are cuffed, well, it's not so good. And obviously, if you want to do reform in the European Union, it's better to have a strong government. But what else is new, right? If Germany gets its act together, it's going to be another country in the Eurozone that has some challenges. And by the way, the German government is functional. They just don't have a coalition government, so they're not going to get major reform done. Obviously, Brexit is on the table as well. That's moving slowly. They seem to be agreeing on many things at a glacier speed, and plenty of nice headlines out there. The one thing that's been a bit under the radar that's worth mentioning in terms of the outlook for next year. This morning, EU finance ministers, not all of them, but I believe it was Germany, Italy, Spain, UK as well, I think one or two others, wrote a letter to U.S. Treasury Secretary Mnuchin, copying a bunch of others, warning them that the U.S. tax legislation is violating World Trade Organization agreements as well as bilateral tax agreements. And then they're pointing out, and I tweeted about it earlier today if you want to look up the specific letter that they wrote, but basically one of the things they argue is that half of the trade between the EU and the US is intercompany transfers, where a subsidiary would move money around, and part of the tax legislation suggests that some of these transfers won't be tax-free anymore, basically penalizing companies for taking money back to Europe under terms and conditions that under bilateral agreements should be tax-free. And so I mentioned that simply because there is a source of a black swan where you could have a potential trade war or trade disagreement coming. And talking about black swans, since this is about what can possibly go wrong, most of you have probably not heard of MiFID II. Now, that's an arcane term. Any professional on the line might have heard of it. But basically, effective January 1st, a new set of stringent rules and regulations come into place that require any asset manager in Europe to follow additional standards. And talking to the large banks, a lot of European institutions are not ready for that. And that ranges from everybody from small asset managers to large sovereign wealth funds. Effective January 1st, they cannot trade anymore. And one of the trends that's been happening is that the number of counterparties has been reduced. One of the side effects of Dodd-Frank and other regulations globally have made it so expensive to deal with counterparties that there's ever more, that we've moved away from the post-2008 model where you want to have multiple custodians to again have just one counterparty you work with. And so if you haven't gotten your paperwork in order, you can't trade anymore. And this isn't just something fictitious. We just today looked at the cost of trading in Europe, and there is some stress in some of those markets priced into things that settle in January. And I'm not saying that as come January 1st, the world is going to fall apart, but there are these unknown quantities out there that will potentially provide stress in the market. And so if fewer people can trade, well, it means a few things. It means that people might have to delever. Maybe if you realize it at the end of the year that you can't trade on January 1st, you're going to take some chips off the table. It means that liquidity is going to be less. It means spreads could be wider. And so all of that tends to favor more of a risk-off sort of environment, which might be then good for the dollar, which might be good for treasuries, which would be a negative for the dollar. Although historically, when you have stress in the markets, many people believe that you have a flight into the dollar. Well, if you look at the last several years, when you had stress in the markets, the euro has often benefited, and because the euro, in my view, has become a funding currency. Now, that's a controversial view because a lot of people are saying that, no, the dollar benefits in crises. I would say the jury's out. It will remain to be seen. A year ago when we spoke, I said that, hey, the dollar index is at 2 standard deviations above its historic mean. That's what you see on this chart. These gray lines are the moving average, and then 1 and 2 standard deviations above and below that. We've come off from those extremes. And so the question is, well, what's going to happen going forward? And the question, in my view, is really what is priced in with a tax reform? If indeed we've priced in a little bit too much optimism and there's going to be a selling on the news, that means long-term rates will not move much higher. Conversely, of course, what could happen is that we have a Federal Reserve meeting tomorrow on Wednesday, and Janet Yellen is going to do a victory lap, as is common in the last meeting of the FOMC, and saying, hey, everything is great, we're going to raise interest rates and turning the world back to normal. And people say, oh my God, we're going to have much higher rates. And by the way, we haven't priced in the tax reform and so forth. Well, my guess is that the market has priced in the tax reform, and it doesn't really matter what these dot plots are with the Federal Reserve. But sure enough, there will be a market reaction tomorrow, and the journalist with hindsight will fill in the blanks and say this is why it did happen. But truth of the matter is that the folks at the Fed are no smarter than anybody else is, so they're guessing as much as anybody else. Let me move on here to China and then talk about the stock market more specifically. There was a headline across my desk a few days ago that when people buy a home in China, and this wasn't news, it just happened to come across my desk again, but it seems to be happening at an increasing rate. A lot of you have heard that in order to tame the housing market, you can no longer get 100% financing a home. You have to make bigger down payments. Well, there's a solution to that. You have multiple purchase contracts. You have the actual one, and then you have the one you show the bank. And so to the bank, you just show them a high amount. And so if you only get 70% financing, well, that happens to cover 100% of the purchase price. And so there's a lot of that sort of stuff happening in an unregulated market, where yes, you have a government that's trying to clamp down, but because they're not particularly effective in what they do, things do kind of on the sides. There's some cracks, and you can do things that to avoid the rules. Until the the meeting they had, their Congress they have every 5 years, markets were going up and up and up in China. And indeed, Mr. Xi, when he gave his big presentation at this Congress, he said he's going to open up the markets more. He seems to be saying that periodically. The practice, though, tends to look a little bit different. And indeed, I don't think it was a coincidence that there was allegations of the government buying stocks towards the end of his speech to make it appear that his speech was very well received. And so since then, the markets have not fared quite as well. So China is a risk factor that people have forgotten about, and they'll have forgotten about it until it matters again. And by the way, there is another risk factor that people have forgotten about until it matters again. This morning, there was a crack discovered, and with that, a pipeline shut down for oil, for North Sea oil, for Brent oil, and that pushed Brent oil higher. And then also, not as reported, a gas distribution point in Austria blew up, and the gas supply to Italy is threatened. Italy is very dependent on Russian gas, and so suddenly energy concerns are on the table again. So things that are completely forgotten can come up very, very quickly. In the meantime, love to show this FANG chart as a reference point. These very popular Silicon Valley stocks that have gone almost nothing but up and up and up. And the question is, of course, always what's going to happen on the right-hand side. Indeed, of late, those FANG stocks have underperformed. Some people have said it's because they are benefiting less from the tax reform. One reason being is that they already pay low taxes, so if taxes go down, relatively speaking, others will go higher. Other people are saying we're reading way too much into that. We have so much computerized trading these days that people are just reallocating after they've performed well and let the big computer make a big allocation shift, and that's going to have an impact. And so it's going to be some of those things. If you want to kind of on the macro side have a longer term outlook, I would be much more concerned for these stocks of what's happening in 2018 and beyond. If we get a President Elizabeth Warren, and I'm saying that here provocatively, I don't even know whether she's going to run, but we currently are in an environment where populism is on the rise. And Trump's pet peeve is, well, it was Mexico. And then they came up with some Mexican heroes. So talking bad about Mexicans isn't quite as popular anymore. So then it's North Korea. Right? Who can possibly have anything good to say about North Korea? So let's talk bad about North Korea. Well, the Democrats are not asleep, so they'll have to find somebody to blame. And so it is quite likely that the Democrats will increasingly blame the Silicon Valley companies for stealing everybody's jobs. And I'm not suggesting that they are. I think we've always had technological innovation, and that's just the times we live in. But in an era where populism globally is on the rise, Trump didn't invent populism, I would be very cautious about what's going to happen in the medium term. And maybe that's only a problem for November 2018. But again, the prudent investor, in my view, takes the long view. And if your particular FANG stocks, to the extent you invest in them, have outperformed, why not rebalance? And we're not giving investment recommendation on this or any particular security, but just something to keep in mind. Now, this is a chart we have shown you a while, emerging markets versus developed markets. Basically, we're looking at a broad index for emerging markets, dividing that by a world index, based on the theory that there are longer-term trends here. And this chart suggests that emerging markets might be outperforming developed markets. And the question is that going to continue or not? I mean, you never know where the right-hand side of this is. If I'm correct that we're going to have risk-off environment, well, then odds are that that in a risk-off environment, the emerging markets are going to underperform. So take that a little bit with a grain of salt. But that said, the S&P has outperformed so many markets that I would be very cautious that institutional investors that are rebalancing are likely to rebalance to other places in the world. And emerging markets are obviously one candidate for that. But other developed markets, I would also think that have a good chance of outperforming. So let me show you a chart here. I showed it in a newsletter several weeks ago. And I intentionally don't show performances here on the side because this is more of a concept that I want to show than actual performances. This is a chart since the 1950s, and the red line here shows the cumulative return of the S&P 500, and then the green line is a 60-40 portfolio, a more balanced portfolio. The risk profile, obviously, of the balanced portfolio is much lower. Now, the reason, with the exercise, and those who are interested can read the newsletter, but that I wrote at the time. But the point of this is, well, is there any way? And I'm going about this backwards now from how I read the newsletter. But is there a way? Assume for a moment you've quote unquote missed this rally, right? A lot of people have missed this rally, and does that mean you should feel bad? Does it mean you should now go into the markets? And so the experiment that I took upon me in that newsletter is that, well, what about if you take chips off the table when the market goes up, and then put it back to work when the market goes down? And that's kind of the 60-40 portfolio idea, but I used a different set of rules. And I'm not going to go into them here because we don't have quite the time, but the result of the strategy that I proposed there is that you're more aggressive than a 60-40 portfolio, basically, to take chips off the table when the markets outperform substantially. And then you go back into the market on decline. So it's a cost averaging, but just a different methodology. And the particular, and then we can change the parameters there, but the choices here in this model are that over the multi-decade run, the risk-adjusted return are actually very attractive. Yes, you've missed the rally of late, and if you only look at the last 10 years, here you see almost flat line, you didn't do so well, but you outperformed the 60-40 portfolio, not over the last 10 years, but over the long run. And the point here just being is, there is more than two strategies. There is more than the S&P 500 and more than a 60-40 portfolio. This, one of the things I liked about it is because it does reflect a little bit my thinking that, for example, around 2000, I didn't like valuations. And so, yeah, you kind of miss a little bit of the upside, but you also don't just get as hurt on the downside. And there are different methodologies you can use to get back into the market. The important thing is that you want to have something that's compatible with your risk profile. And please look up that newsletter again if you want to get into details, and reach out to me if you want to discuss that in more detail. So back to reality, meaning back to what's actually happening in the market. This here is the S&P 500 on the black line, on the gray line, and the black line is gold. Now there are two different scales here, so mind you, that's a little confusing here. There are two different scales, but actually they're the same scale. They're log scales here. But the point here being, what I want to show in this chart, and I've shown you related charts, that historically, when there is a bear market, and these red periods are markets where the S&P 500 has dropped 20% or more, gold has historically done well in each bear market since the early 70s, with the big exception of the bear market in the early 1980s. That is when Volcker hiked up real interest rates substantially. And the reason I like to show that is that one of the reasons why we see the price of gold hold up despite higher real rates is, where the heck do you diversify to? Right? I tell you, take chips off the table, but where do you take the chips to? And the classic way is you put into bonds, but bonds don't yield anything. And so that may actually still be better than having negative returns. But in order, what you really want to have, that 40 bucket in the 60-40 portfolio should really be an uncorrelated bucket. But what is uncorrelated? When central banks have made bonds more correlated with equities. And that is why people keep coming back to gold, because gold in the long run, the monthly correlation to gold in the S&P 500 on this chart is just about 0.0. Now, in the short term, there might be correlation, and it's not always the best diversifier, but it's the easiest diversifier. If you go beyond that, maybe you can take the beta out of the stock market with some put strategy in the S&P, or you have a long-short equity portfolio, or you have a long-short currency portfolio. I mean, that's why we focus so much on the currency space, because we We believe we can generate uncorrelated returns there. We can do that there by design, but that's way too complicated for most people, and that's why people come back to gold. And these days, I have to almost put Bitcoin on the same chart as gold. I get a lot of calls and questions about Bitcoin, and obviously now that we have a futures contract out there, there's more questions about Bitcoin. Fred Hickey, he used to be part of the Barron's Roundtable, and he publishes a monthly newsletter, a very good read if anybody is interested. He says in his latest newsletter that Bitcoin is kind of the cherry on the cake. And what he's referring to is, and I would tend to agree, central banks have created inflated asset prices everywhere. He calls them bubbles. I would tend to agree with regard to many markets. And it is not surprising that in a world where returns are minimal in many ways, that people are lured into things that promise extraordinary returns. And so something that goes up 10% a day or a month or whatever it might be gets a lot of traction. And so a lot of retail investors are chasing into that. My view is that cannot have a good ending, meaning that the meteoric rise of Bitcoin is not sustainable. And the issue here, I don't think there's anybody will have a problem buying Bitcoin at 10,000 and selling at 12,000, or those who take profits now are fine. And those who have a little bit of a loss because they get the trading wrong doesn't matter. The real tears will come when Bitcoin drops to, say, 6,000, and then people say, oh, it is a fantastic buying opportunity because, hey, it was at 17,000 just a few weeks ago, and it's going to go back up. And then instead of going back to 12, 14, 16, 17,000, it plunges to 1,000 or below, or 500 or whatever it might be. That's when the real big losses happen. And so the tears happen at the tail end of that sort of frenzy. Now, with regard to gold, Bitcoin is not gold no matter how it is represented. Gold is a physical asset, doesn't pay a dividend. It just is, it's just gold. Bitcoin is a virtual currency that's mostly a speculative instrument that has many other attributes. It is also not a currency. It is a speculative asset. And if you like Bitcoin, good for you. But don't think you have a currency, and don't think you have a store of value. A store of value suggests something of stability. And Bitcoin is many things, but it's not stable. And obviously, if you have something that goes up in price every day, you probably prefer that over something stable. I just like to caution that I just don't think that's going to happen. So before we go to the Q&A here, just one or two more points. Again, I happen to believe that the central banks have compressed risk premia. As they move away from that, volatility is going to increase. And this is an old cartoon to kind of signal the handover at the Fed. This obviously to Mr. Powell from Madam Yellen. And Bernanke, similarly, when he was done, he kind of had a victory lap. And I just have to pause because if you look closely on the lower right-hand side of the screen, it says forecasts are inherently limited. So that's a copy and paste from another chart. But clearly that user manual might have some monetary predictive power in it. And so take that as is. Anyway, Mr. Powell is a lawyer. Madam Yellen was a labor economist. Powell knows the insides out of bank regulations, but in my view is completely agnostic to monetary policy. The Fed may be on autopilot until it isn't. He has never given a speech with original content on monetary policy, as far as I can tell, which doesn't mean that he can't figure it out, but which means that, in my view anyway, that he will have committees decide or give him input. He's going to rely more on the staff at the Fed and maybe somebody influential on the FOMC to give him guidance on what to do. And yeah, he's an intelligent guy, he can probably figure it out. But one of the core principles at the Fed is that you don't want to be bullied around by the markets. In practice, of course, the markets do bully around the Fed. And so if and when there is going to be a flare-up in volatility, and let there be a flare-up that's going to be lasting more than 5 minutes or a day or two, Powell will convene the committees and will decide on how to address them, whether the so-called financial conditions will have deteriorated. Well, guess what? That's going to take time because unlike somebody who is kind of more the manager who could immediately act, I would think it's going to take a time to react. And there's a lot of damage that can be caused to risk assets in that process. So that's really where I see the biggest risk factor, so to speak, with a Powell Fed. And then we'll just have to see whether he even cares about interest rates. He'll certainly know how to do the smooth talk in the beginning, but let's see whether he can instill the sort of confidence that's needed as the markets go. And so this is not a product presentation. This is just a quick highlight of who we are. We manage several investment products, and these days we also provide institutional services. So if you're a large institution and are looking for uncorrelated returns, please reach out to us. And if you're not so large, then by all means also look up what we do. And in January we'll have our quarterly fund webinar again, where we talk about the products. So as I hand it back to David, just a reminder that look out for an email on Thursday. We'll really send you an in-depth study on the business cycle as a sample of other in-depth research materials that we could provide you if you have an interest in that. And the reason here is that every 2 weeks, we have an in-depth research meeting where we go through a gazillion of charts, and we thought there might be an interest out there to share those with you, that you might want to see what's happening behind the scene, and be very interested to hear whether you like that sort of thing, whether this is something that we should build out. More on that in the email that's to come. So let me pass it to David for the Q&A.
Great, thanks, Axel. So please now take a few minutes to read the following disclosure, as you see on your screen. We'll move to the Q&A portion of the call. Again, we can still ask any question by typing it into the text box. And our first question comes from Victoria Harris. And she asks, how safe are U.S. Treasuries if the debt ceiling is not raised in time? Axel?
Well, that question comes up whenever the debt ceiling, I guess, gets reached. You see a little blips in the markets usually that prices in the risk of a delay. And so people will try to buy treasuries that are not in that window when any mess might happen. Ultimately, everybody knows that the U.S. government has to pay its obligations. And so there's the risk of the government not paying its obligation is extremely low, but that doesn't mean there can't be a delay. And so, yeah, if the dynamics are particularly hostile, it's possible that there is some chaotic thing happening. The odds of that happening anytime soon, I think, are very low. The government has ways to scramble and find some money somewhere. And by the way, the government can print its own money, and so they can never default from that point of view. But you can cause disruptions in the markets, and if they do it, then you have to price, and they'll do it again in the future. And so in the long run, the implication would be that the cost of borrowing for the government would go up. But in the meantime, it's mostly political show. David?
Okay, next question comes from Ted Gioka. The question is, what will the tax bill do to the dollar? Axel?
That's an excellent question, and we've had lots of pundits give their view. Remember that we were supposed to have that border adjustment tax, and the dollar was supposed to go up by 20%. Last time I checked, the dollar weakened substantially this year. And so ultimately, it does appear that the tax bill is stimulative. I say it appears because it is still extremely confusing. If you are on the coast, a high-income earner, it's possible that your tax rate goes up. You can no longer deduct your state and local taxes. You'll have a standard deduction, but if you're a high earner, that's not going to be sufficient. So your tax rate might be going up. There are even some scenarios where you might, on a marginal tax, have over 100% taxation. Wall Street Journal just had an article on that. Will that impact consumer spending, or does that only affect folks who are too wealthy and they don't really adjust their spending pattern? Similarly, on the corporate side, will they really invest more money if taxes go down? In my view, real tax reform needs to simplify the tax code. and make it easier on the regulatory side, make it more transparent. And so then you can tackle products more. What I'm reading is that any lawyer who's an international tax expert, I'm not just reading, I have friends who are in that business, they say they'll never have to pitch any new projects because they'll be busy for the next 10 years trying to implement this. This tax bill is way too complicated. And so people will need to distill it. And so there's some talk about only implementing in 2019. I think that would be a feature rather than a bug, because you cannot expect the stimulus to happen right away when people haven't even digested of what's in it. So for it to be good for the dollar, it needs to have clarity, which I don't think there's much of it, but we'll hear more as we have the final bill. Ultimately, it is net stimulative. And then it depends on how the dynamics work out. And most notably, what is important is what is priced in. We've had the equity markets go up substantially, and we've had the bond market also weaken quite a bit. And so maybe all of that is priced in. And so we really have to see how it's going to play out to see what the impact is for the dollar. I happen to think that the big opportunity here is that Mr. Draghi at the European Central Bank is going to change his mind and going to say, hey, maybe our rates don't have to be quite as negative, and therefore we're going to step away from QE maybe a tad further than the market is pricing in. David?
Okay, our next question comes from Andrea, and she asks, it's understood that once the yield curve inverts, that it may take 4 to 6 months for the markets to repose. What else can we monitor for early signals, and for what sort of action can be taken? Axel?
Yeah, so I talked about the yield curve earlier. Again, on that research piece we're sending out on Thursday, we'll talk about the yield curve in great depth as an indicator. I talk about watching quantitative tightening, and in that context, the ECB stopping its easing cycle is very, very relevant. And so volatility is ultimately increase in volatility is going to deteriorate financial conditions, which makes it, and deterioration of financial conditions means that it's more difficult to get a loan, aside from all the other things I've mentioned before. The trigger for that, the catalyst, with hindsight, I'll tell you what it was. So something like the yield curve inverting is obviously a symptom, and is it a symptom or a cause, right? I mean, if the Fed is aggressive in hiking rates, yeah, they could induce that. But the yield curve could also invert for other reasons, right? A flattening of the yield curve can happen through a hiking of short-term rates, or a lowering of long-term rates. And lower long-term rates can happen simply because you have a risk-off environment. And so it's not clear always whether this is a cause or an effect or something along those lines. And by the way, let me just go back to the tax reform. There's one item I wanted to mention earlier, and that is one of the key things in the tax reform that I think has been underreported is that in the tax reform, it's going to be more attractive to issue equity than to issue debt relative to what we have right now. So currently, all interest expense is tax deductible for a business, as I believe is the proper thing to have, but the tax reform puts limits on that. Financial institutions have exclusions in that, but generally speaking, there's a limit of how much an interest expense as a business you can deduct. And what will happen as a result, that financing growth with issuing equity is going to be more attractive. And so there you have another thing where the supply of equities might increase, and the supply of bonds may not, at least when it comes to this particular parameter, which ultimately supply going up is the price going down. That means a headwind potentially to equities. Back to you, David.
Okay, next question comes from Stephen Miller, and he asks, well, about your thoughts on the Japanese stock market. Axel?
Oh, goodness. Well, the Japanese stock market has done quite well of late. It's historically quite correlated to the yen, and I haven't talked much about the yen, so let me maybe talk about that a little bit. The yen is very much, and the weaker yen tends to be a stronger market, a Japanese market. The yen historically is quite correlated to the spread between the rates between Japan and the U.S., and because rates in Japan are near zero, so you look at the U.S. rate to see how Japan is doing. And so that's why you have a quote-unquote risk-off environment. When treasuries are rallying, U.S. yields, long-term rates go down. That's when the yen tends to go up because that spread is declining. And so the question here is that, again, what's going to happen going forward? Our rates are going to go higher because we're going to have such amazing growth, or are we going to have a risk-off environment? I think the jury is out. My personal view is that the risks are tilted towards a risk-off environment. And just so partly, I mean, besides from the fundamental reasons, the law of numbers, having had so many good months and years, is just very, very difficult to repeat. And so if that is to happen, well, you might have a flight into treasuries, and that will cause the risk-off environment in which the yen historically rallies, and so that then can affect the Japanese market, the stock market ultimately. Back to you.
Okay, next question comes from Sal, and he asks, how do you see real estate prices, especially on the coasts, being affected by the various forces you've outlined? Axel?
Well, I didn't get into that in too much detail, but the real estate community, the broker community, is of course very worried about the limitation on deductions on mortgage interest rates. And by the way, property tax deduction is also going to go down. And so on the coast, you tend to have higher, more expensive real estate, and so the deductions are going to be lower. Now, that said, if you look at Silicon Valley, many houses have a $1 million mortgage on them. And they don't have a $1 million mortgage on them because people can't afford to buy those homes. It's because the interest on $1 million is tax deductible, and therefore they can gear themselves up and have an extra $1 million to play around with in the stock market. And so in that segment of the market, I don't think it will have too much of it. On the high-end market, may not necessarily have too much of an impact. Now, that said, all these subsidies, and a mortgage interest rate deduction is a subsidy. If they go away, that's obviously a headwind. And so if you have if you don't have mortgage interest deductible anymore, prices get lower. And by the way, that is what makes homes more affordable. A home mortgage deductibility does not make homes more affordable. It makes it more affordable for the current buyer, but not for the buyer tomorrow. And so if you want to have good housing policy, actually it is good not to have these sort of things deductible in the medium term. Now, if you combine that with what I just said earlier about potentially Silicon Valley being the new bad boys, meaning that it's the bad tech companies that steal our jobs, well, hey, and let's regulate Google and Facebook like utilities. I'm not suggesting that's going to happen tomorrow, but that might put a dent on their stock prices, and that might put limits on the stock options available, and that is going to have an impact on the home price of Silicon Valley. Now, you asked me about the coast, and the coast is a little bit bigger than just Silicon Valley. We obviously have had a very nice run on the home prices. Low interest rates have helped to propel that. You have a reasonably good economy right now, and so right now I don't see a threat to home prices, but and I think that some of the whining of the real estate industry is just that. So it is going to be the overall economy, I think, that's going to dictate that in broader terms. But I do think that in Silicon Valley, where you have particularly high prices, things are a tad more vulnerable, and indeed pricing has also been a tad softer here in the region. I say here because I'm based in Silicon Valley. Back to you.
Okay, and our last question comes from Tim, and he asked about gold allocation. So gold is often referred to as an insurance, and the recommended sizing is 5 to 10% or a little more. Gold in this role is said to protect purchasing power. I would not insure my house or property for only 5 to 10% of replacement value. What gives? Axel?
What gives is regulation. Anybody who is regulated, and that includes me, we are not allowed to give a specific investment advice, simply because I don't know your situation. I don't know if we have an audience of many people listening. So I cannot say that for you, 5% or 10% is the right allocation. And so 5 to 10% is either because you got to say something or you have something to sell. It has comparatively little to do what actually your need is. And so let me put that out there. Now, that said, to your point about insurance, right? A prudent investment allocation is diversified. Now, anybody who has been diversified has been underperforming the markets. And so let's assume in the run-up to 2016, you had a diversified portfolio, you put things into many baskets, you underperformed the markets, and now early 2016 came along and we had this very significant correction in the markets. Well, odds are, to your point, that your insurance wasn't sufficient and you still lost money. So you underperformed on the way up, you still lost money on the way down, and a lot of investors have thrown in the towel and saying, what the heck? Why don't I just buy the S&P and worry about nothing else? And this isn't just a theoretical thing I'm saying. I'm talking to a lot of professional investors, and some of you are listening. You have lost clients because you were diversified, and so you have shifted portfolios into riskier allocations, and so that has been one of the drivers why the markets have been going up, in my view, anyway. And so, what is the right solution? Well, the right solution, in my view, is that you truly are diversified, which means you're stress testing your portfolio based on statistical attributes, and gold just happens to play this role particularly well. We have a study on our website that says if you've had a 40% allocation to gold, you've had much better risk-adjusted returns. Now, I'm not suggesting that you should have that. And hindsight here is obviously helpful because, hey, with hindsight, I know gold has gone up, right? Even over multi-decades. You never know what's going to do it tomorrow. So gold is kind of the easiest diversifier. But the short of it is that if you want to have a robust portfolio, you truly got to see whether you have things in your portfolio that are uncorrelated. And gold is one consideration there. Cash isn't a bad option. Long short something might be another option, including long short currencies, which is what we do. But those are all attempts of providing diversification. Diversification means uncorrelated, and yes, that does mean that it underperforms the S&P when the S&P goes up 20% year after year after year. That's the whole point of diversification. That doesn't mean it's bad to do something prudent. Cash is a bad investment if you hold it for 20 years, but as a diversifier, it can play a very important role when asset prices are very elevated. So with that, I hand it back to you, David.
Great. Thanks, Axel. And that concludes the Q&A portion of our call. And if you were not able to get to your question today, we will get back to you via email. So should you have any additional questions or comments, please use the Contact Us section on our website at www.merkinvestments.com. As always, feel free to reach out to James at any time, and he'll be more than happy to help you with any questions. Also, for future webinars, if there is a topic that you're particularly interested in and would like us to cover, please let us know through the comments box. This concludes our call. Happy holidays and have a great day.